Somewhere on Earth right now, there's a market bigger than every public stock exchange on the planet combined. Most people have never looked at it, never traded in it, and couldn't tell you what it actually does. Yet it already decided your mortgage rate. It's currently figuring out if your landlord will raise the rent next year, and it played a major role in deciding how many people got laid off at your company in 2023. That market is bonds. It is not an exciting or flashy system. By ignoring it, you are allowing an entirely unseen financial engine to quietly price and dictate your financial existence every single day without your input. Strip away the financial jargon, and a bond is incredibly straightforward. It is an IOU. A government or a company needs money, so instead of going to a bank, they borrow it directly from investors. This diagram outlines the basic baseline transaction. You hand over money. In return, you get a fixed annual payment, called a coupon, and you get your original amount back on a set date, called maturity. But let's say a year later, global interest rates rise. Look at this new bond appearing next to your original 3% bond. Because rates are higher, brand new bonds of the exact same type now pay 6%. Nobody wants your old 3% bond at full price anymore because a better deal is sitting right beside it. Here we can see the mechanism that fixes this imbalance. The only way to sell your original bond is to drop its price until that old fixed payment mathematically works out to a 6% return for whoever buys it. Your bond didn't fail. The economic environment around it changed, and the price had to catch up. When interest rates rise, existing bond prices fall. That one mechanical adjustment drives every economic story that follows. If you want to find the single number that quietly runs the American economy, look at the yield on the 10-year U.S. Treasury bond. Even if you never plan to buy a bond, it matters to you. When a bank considers writing you a mortgage, it runs a simple calculation. It asks why it would lend money to a regular person for 30 years when it could lend that same money to the United States government, virtually risk-free. This chart shows exactly how your bank builds your loan. They start with the virtually risk-free Treasury yield as a base block, say around 4.5%. Then, unless you pay extra to account for the risk that you might lose a job or miss a payment, they won't lend to you. Add roughly 2 percentage points for that personal risk premium, and you get today's 6.5% mortgage rate. This calculation doesn't stop at houses. Auto loans, credit card rates, and the cost of capital your employer uses to decide whether to expand their business are all priced directly off this exact same baseline number. When the 10-year yield climbs, nearly every borrower in the country effectively gets the same rent increase at the exact same time. Companies that borrowed cheaply suddenly have to refinance at much higher rates, triggering nationwide hiring freezes and layoffs. For decades, standard financial advice told us that stocks were the risky part of your portfolio, while bonds were the safe seatbelt. Then 2022 happened, and bonds crashed right alongside stocks. This visualization maps a hidden metric called duration. Duration measures exactly how vulnerable a bond is to interest rate changes. If a bond fund has a duration of 6, it loses roughly 6% in value for every 1-point rise in rates. When the Federal Reserve rapidly raised rates from near 0 to over 4% to fight inflation, the supposedly safest bonds on the planet, long-term U.S. Treasuries, plummeted in value because they carry very high durations. In March 2023, Silicon Valley Bank took in billions of dollars in deposits and parked that cash in those exact same long-term bonds. They were holding boring, conventional assets, right up until rates spiked and wiped billions of dollars off their balance sheet on paper. Silicon Valley Bank collapsed because it mismatched safe long-term bonds against deposits that could leave instantly. The basic mechanical seesaw of the bond market did the rest. This market also acts as a ruthless judge of entire nations. Through most of 2025, France went through one government collapse after another. Investors holding French government bonds repeatedly demanded a bigger premium to lend to a politically unstable state that couldn't agree on a budget. At roughly the same time, borrowing costs in the United Kingdom spiked to their highest levels since 1998. The bond market punishes any government whose budget math it distrusts, regardless of the country. And sometimes the bond market isn't even reacting to domestic politics. When conflict in the Middle East caused global oil prices to surge, countries highly dependent on imported energy watched their currencies weaken sharply. To defend the yen from these external shocks, Japan's central bank was forced to sell massive amounts of its U.S. Treasury bonds just to buy its own currency on the open market. Over the last 2 decades, the global appetite for U.S. debt has drastically shrunk. Foreign ownership of American bonds has plummeted as central banks everywhere face their own local economic pressures. Every mortgage payment is tethered to foreign currency wars, oil tankers in the Persian Gulf, and the rest of the world's diminishing trust in debt. This brings us to the largest borrower of all. The United States currently owes around $39 trillion. Today, the federal government spends roughly $1 trillion a year just to cover the minimum interest payments on that debt. Looking at this chart, you can see how that $1 trillion interest expense stacks up against other major national priorities. The budget required to simply service the debt now physically eclipses the expenditures for national defense and Medicare combined. There is a historical principle known as Ferguson's Law. It states that any major power spending more on debt service than on defending itself is at severe risk of losing its superpower standing, as the debt slowly suffocates everything else the government needs to do. When the U.S. lost its last remaining top-tier credit rating, it marked the moment mathematical forces became impossible for the government to ignore. You can actually use this context to protect yourself. First, stop leaving your cash in near-zero savings accounts. By moving that money into short-term Treasury bills or high-yield accounts, you can capture these higher interest rates with comparable safety. Second, understand the critical difference in how you buy debt. If you hold a single bond to maturity, you are guaranteed to get your principal back. But a bond fund never matures. It gets repriced every day, carrying a much higher risk of loss when rates rise. If you do own a fund, explicitly check its duration label. That number tells you exactly how big of a bet you are making on the direction of interest rates. And keep an eye on the 10-year Treasury yield itself. It is the ultimate check engine light of the economy, a singular metric you can watch to predict where all other costs are heading in the weeks to come. You do not need to be a Wall Street trader to navigate this, but you do need to understand the invisible mathematical engine quietly pricing your entire life, because it's going to keep turning, regardless of whether you are paying attention.